Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Erie Indemnity Company Annual Report. Erie Indemnity Company offers a wide range of services to its subscribers through the Erie Insurance Exchange. At the core of their operations are issuance and renewal services, which enable customers to purchase or renew policies with ease. The company also provides sales-related services, including agent compensation and support, to facilitate smooth transactions between agents and clients. In addition to these services, Erie Indemnity Company offers underwriting services that involve evaluating risks and processing policy applications. This ensures that subscribers receive the right coverage for their needs. Furthermore, the company provides customer services and administrative support, which cater to the diverse needs of its subscribers. Information technology services are also offered to enhance operational efficiency and provide a seamless experience for customers. Overall, Erie Indemnity Company's comprehensive service portfolio makes it an essential partner for the Erie Insurance Exchange in the United States. By providing a range of services that cover issuance, sales, underwriting, customer support, and administrative tasks, the company plays a vital role in ensuring the success of its subscribers. The significant drop in Erie Indemnity Co.'s stock price can be attributed to a combination of factors that have negatively impacted investor confidence and the company's financial performance. One major contributor to this decline is the disappointing Q4 2025 earnings report, which fell short of market expectations for both revenue and earnings per share. Analysts had already cut profit estimates by nearly 49% in the lead-up to the report, indicating growing concerns about the company's profitability. Another factor that has weighed on the stock price is a substantial charitable contribution made by the company. The $100 million after-tax donation to the Erie Insurance Foundation significantly impacted net income for both Q4 and full year 2025, contributing to the decline in stock value. The announcement of CEO Tim Nicastro's retirement also played a role in the stock's decline. This leadership transition has raised concerns about the company's future strategic direction and may have eroded investor confidence. These factors combined to drive the stock price down by over 32.37% in the past year, with the stock reaching a new 52-week low of $267 on February 23, 2026. Erie Indemnity Company market capitalization of $14 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Erie Indemnity Company holds a significant advantage in their industry. Erie Indemnity Company trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 5.97 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 31% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.11%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of the key factors influencing an insurance company's financial performance. On the revenue growth side, several factors contribute to increased earnings. Direct and affiliated assumed premiums written by the exchange are a significant driver of revenue growth, as are management fee rate increases and higher average premium per policy. Additionally, renewal business premiums growth, rate changes implemented by the exchange, personal lines, and commercial multi-peril premiums written growth, and investment income from fixed maturity and equity security portfolios all contribute to increased revenue. On the other hand, several factors can lead to a decline in revenue. Decreases in new business policies written, competition from other insurance companies, catastrophic events straining claims processing, reputational harm due to customer service issues or negative media coverage, financial condition of the exchange, and decreases in income taxes paid all contribute to reduced earnings. Furthermore, increases in cash paid for agent commissions can also negatively impact revenue. It is worth noting that changes in market conditions, affecting investment portfolio performance and economic trends impacting business conditions and credit for issuers of securities are other notable trends that can influence an insurance company's financial performance. These factors can have a significant impact on the company's ability to generate revenue and maintain profitability. The net income of the company experienced fluctuations between 2023 and 2025. In 2024, it increased by a significant 34.6% compared to 2023, reaching a notable milestone. However, this growth was short-lived, as the net income decreased by 6.8% in 2025 compared to 2024. The profit margins also underwent changes during this period. The operating income margin saw an increase of 1.8% in 2024 compared to 2023, but declined slightly by 0.2% in 2025 compared to 2024. Meanwhile, the net profit margin decreased by 1.9% in 2025 compared to 2024. The decrease in net income and profit margins in 2025 can be attributed to various factors, including a decline in revenue or an increase in expenses. Despite the initial growth in 2024, the company's financial performance seems to have regressed in 2025. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. As per the latest data, the net cash provided by operating activities in 2025 reached $686,657,000, marking an increase from the previous year. This upward trend is a clear indication that the company is successfully generating positive operating cash flow, which is a crucial aspect of any business's financial health. The company's financial performance has undergone some notable changes in terms of its debt level and interest expenses. According to the extracted summaries, the total liabilities have increased by a significant 18.9% from $1,070,789 at December 31, 2024 to $1,368,061 at December 31, 2025. This increase in debt level is evident on page 43 of the summary. However, despite this rise in debt, the company's interest expenses have actually decreased. According to page 35, the interest expenses dropped from $1,048,549 in 2024 to $1,018,957 in 2025. This reduction in interest expenses suggests that the company may be benefiting from lower interest rates or more favorable loan terms. Overall, while the debt level has increased significantly, the decrease in interest expenses is a positive development for the company's financial health. The performance of various segments within a company can be an important indicator of overall success. According to the extracted summaries, one segment that stood out was management operations. This segment saw significant growth in revenue and net income from 2023 to 2025. The increasing financial metrics suggest that this segment is performing well, contributing positively to the company's overall performance. Management is aware of the challenges facing the company in the competitive property and casualty insurance market. They acknowledge that reduced sales and lower premium revenue are possible due to these challenges, but emphasize the need for adaptation to maintain financial strength and competitiveness. To mitigate risks, management is taking steps to adapt internal processes and systems to address increasing cyber threats. This includes maintaining system availability and managing technology initiatives effectively. Additionally, they will focus on underwriting discipline and pricing sophistication models to support risk selection and long-term rate adequacy. The company's strategy also involves increasing bond and cash equivalent income, which has led to a $15.7 million increase in net investment income due to higher average holdings and bond yields. Management continually reviews the investment portfolio for impairment and determines whether it is due to credit loss or other factors. Management continues to monitor the sufficiency of liquidity and capital resources given potential economic disruptions. They invest primarily in fixed maturity investments, which comprised 85% of their invested assets at December 31, 2025. The company's employee pension plan utilizes a return-seeking and liability asset matching allocation strategy based on the understanding that equity investments will outperform debt investments over the long term. This diversified portfolio reduces volatility across investment styles and markets. Overall, management is focused on adapting to market challenges, mitigating risks, and maintaining financial strength through effective risk selection, underwriting discipline, and a diversified investment portfolio. The company's financial transactions for acquisitions and divestitures are limited. There is no clear indication of any significant acquisitions, except for a potential acquisition mentioned on page 32, but its status remains unclear. On the other hand, there is one notable divestiture. The Erie Insurance Foundation received a $100 million charitable contribution in 2025, which can be considered as a form of divestiture. Additionally, 2 senior secured loans totaling $13.6 million were issued to fund a real estate development project in 2023, indicating that the company has divested funds into this venture. The company's financial activities have been notable in recent years. One of the key highlights is its commitment to rewarding shareholders through dividend payments. The company has indeed paid dividends, providing a tangible return on investment for its stakeholders. In addition to paying dividends, the company has also taken steps to enhance shareholder value by buying back shares. This strategic move demonstrates the company's confidence in its financial position and its desire to optimize its capital structure. Supply chain disruptions pose concerns for companies. There are growing concerns about supply chain disruption, which can have far-reaching consequences for businesses. Unexpected economic or social inflation caused by supply chain issues and changes in tariffs are potential risks that companies may face. These disruptions can impact a company's operations, as highlighted on page 21 of the report. While there is no specific information provided on inventory buildup, the focus is primarily on supply chain disruption. This suggests that companies should be prepared to address any potential disruptions that may arise from changes in tariffs or other economic and social factors. By being proactive, businesses can mitigate the risks associated with supply chain disruptions and ensure continuity of operations. That concludes the financial summary for Erie Indemnity Company. Feel free to comment below, and I will be happy to answer them when possible.